Hi, I'm David Stein of Money for the Rest of Us. And in this video, we're going to take a look at special purpose acquisition companies, SPACs. What are they? Why you should be careful with them, but an interesting way to invest in SPACs that I've been experimenting with that's worked out pretty well, at least in the last few months, that you might like to give a try. Now, this information on SPACs comes from an investment guide that I wrote on my site, Money for the Rest of Us. What are SPACs and should you invest in them? On that guide, there's a flowchart or a schematic that we're going to walk through that'll help you understand how SPACs work. It starts with an initial public offering. This is when a sponsor of the SPAC raises money in the stock market, the public market. The stock is newly listed on the exchange. And as investors can participate in that SPAC, and they might raise several $100 million or more with the purpose of finding a company and doing what's known as a reverse merger to find a target and a private company, and then that private company will be merged into this SPAC and then will be newly listed on the stock market. Now, there's two classes of shares. There's the Class A common shares and warrants. A warrant essentially gives the investor the right to purchase additional shares in the future. But there's also Class B founder shares. What's interesting about these founder shares is that the sponsors, the founders, don't have to pay very much for them. Very, very small percentage. And then if they find an acquisition target, the founders get 20% of the new company. Here's the thing about SPACs. The biggest beneficiary are the founders. If they can find a target, they get a meaningful allocation to the newly listed company after the reverse merger and don't have to put up much money up for that. And they have limited downside if it doesn't work out, which we'll see as we continue on the flow chart. They raise the money. There's the Class A shares, the Class B shares, and then it goes into an escrow account. And at least 85% of the funds have to be held in that escrow account. And it's conservatively invested, typically in government bonds. Now, it has to be 85% minimum, but typically it's closer to 95 to 97%, with the rest of the funds held in a reserve to cover expenses, including due diligence expenses to try to find a company. SPACs have about 2 years to find a company. They're searching and they're trying to find an appropriate merger partner. Now, here's the really cool thing about SPACs and why I like them. Because most of the money is invested in government bonds, treasury bills, while the SPAC sponsors are looking for an acquisition target, there's limited downside to the SPAC. Typically, they're issued at $10 per share, and they stay pretty close to $10 per share, unless for some reason market participants think that the sponsors are going to find a really intriguing company, and then the SPAC might start to go up in price, closer to $10.50 to $11 per share. I don't ever buy a SPAC for more than about $11 per share, and typically I want to get it as close to $10 per share as possible. And I also don't ever buy it at the IPO. I just wait until it's already listed, and then I buy the SPAC. So the SPACs have 2 years to find a company, and then if they do, they make an announcement. And there's an announcement date, and that's typically, if shareholders are excited about it, the SPAC can jump in price. Might be 15%, 20%. I've owned SPACs where it jumped 50% on the announcement date. At that point, there's a proxy vote, and there's a decision. The shareholders get to decide whether the acquisition should be approved or not. And I want to make sure that I get this right in terms of how the voting works for the SPAC, so that, because it's a little complicated, it's right there in the middle. If more than 50% of shareholders approve the acquisition and less than 20% of the shareholders vote for the liquidation, then the transaction is approved and the acquired firm is listed on the stock exchange. If more than 50% approve the transaction, but more than 20% of shareholders want to liquidate their shares, then the escrow account is closed and the proceeds are returned to the shareholders. Now, obviously, if most of the people vote for liquidation, then the money is is returned to shareholders. And so there's a chance for the investors to decide, well, do they even like this acquisition? So we have this decision point. Is the money returned to shareholders or does it move forward? Now, I neglected to mention that if the SPAC can't find an acquisition target, then the money is also returned to the shareholders. But generally speaking, because the sponsors have an incentive to find an acquisition, because they get 20% of it without having put up much money, they're incentivized to find something. And maybe it's not an even good acquisition, which is why you have to be careful with SPACs. Now, if the proxy vote passes, then the SPAC will often get additional debt or equity funding in order to complete the reverse merger. At that point, the newly issued company is listed on the exchange, and it's just like a regular publicly traded stock. That sounds well and good, but what about performance? Here's the thing. SPACs, after the acquisition, most underperform the stock market. In fact, most underperform traditional initial public offerings. And so a lot of the SPAC ETFs out there, if they're invested in companies that have already gone through the acquisition, they tend to not keep up with the market. But there's an interesting thing about SPACs and how I invest in them, that we can take advantage of the structure and see if we can pick up some return. What I do is invest in about 50 to 60 SPACs. And I haven't even done a whole lot of research on them. I used a Robinhood account, and typically it will own 50 to 60 shares of a number of different SPACs. And then I just hold them, recognizing there's not much downside. They stay close to $10 per share. And then once the acquisition is announced, I'll see if it pops in price. And if it does, I'll sell it right away. And then I'll go buy another SPAC that hasn't announced an acquisition yet. I started at the beginning of 2021. The account's up about 6.5% so far. Granted, it's somewhat of a frothy market right now, so there's a lot of enthusiasm for SPACs, so it'll be interesting to see how this goes over the next year. I don't anticipate earning 5 to 6% per month investing in SPACs, but I like it because there is that downside protection, because there's this proxy vote structure where the shareholders have to approve the acquisition or not. Now, you can learn more about SPACs in the investment guide I wrote, where I go into even more detail. I quote some academic papers that showed what performance has been, including this academic paper where they did the research and discussed how this strategy of holding SPACs until the acquisition is announced and then selling it shortly thereafter. In their study, they earned a median return of about 7.5% per year. We'll see how I do. I'll continue to update my performance on that SPAC investment guide at moneyfortherestofus.com. I hope you've enjoyed this video. If you have any questions, you can leave those in the comments. Please be sure to like the video and subscribe to my channel if you have found this video interesting. Thanks.